Simon, it's all yours.
Thank you very much. What I'm going to talk about just now for the next 30 minutes or so, I think, as mentioned earlier, we had a very high-level view of the global energy supply and demand balance, and then maybe a low-level flight over the North Sea. I'm probably somewhere a sort of cruising altitude in terms of my height, and I'm going to be talking specifically about trends in the upstream industry, and I think providing a bit of context for where Denmark finds itself, where the North Sea finds itself, essentially where the industry is globally and the challenges that are confronting the North Sea overall. It's important to think about the wider context when you're considering what you're going to be doing with your industry. So the first thing, what's happening with discoveries? And I think it's a clear trend that what we're seeing is global discoveries are going down. We're seeing a decline in overall oil and gas finds. 2013 actually was a very, very low year for oil and gas. You can see there the lowest, in fact, for about 20 years. And what that reason for that is a number of things. We're seeing not just harder to find resources, but we're also seeing less opportunity. You may be aware that, for example, in the Middle East, there are a few problems. There's not so much exploration going on. We've also had issues with maturing basins. Governments are becoming more and more competitive in terms of the amount of resource they want to take for themselves. And so we're seeing an increasingly difficult upstream environment, which is leading to less and less discoveries. When we look at it in terms of oil and gas, it's actually quite a different story in a way. I mean, you're looking at an overall trend that's going down for both to a certain extent, but gas is not so much of an issue as oil is. Oil is clearly declining in terms of its overall field size, in terms of the discoveries we're making, and in terms of the volume and resource available. Gas, less of an issue. Gas is really one of those things that you find almost by accident now. Oil is really the key thing to be looking for most of the industry. And what you're looking at here is two differing trends. And what that means for somewhere like Denmark, I think where you have a more mature basin, is that you actually have more opportunity. There's actually more investment going back and looking again at areas that may have been passed over because those new discoveries are not as prolific as they have been in the past. They're not as big. There aren't as many of them. And so what you're seeing is an industry that's really thinking about how they can get more out of the existing resource base as well. So it's not just simply a story of finding new resources. It's also a story of making the most of the resources that you already have. And this really illustrates the fact that we are looking further and further afield. And this will play into the overall and wider context of what I'm going to talk about in this challenging environment. We're having to go deeper and look further away for oil and gas. You can see that going back to, 1980s there, it was still very much onshore oil and gas discoveries we were finding. It was still this is sort of the easy stuff, if you will. The things that you could always drill fairly inexpensively, cheaply, and find fairly large discoveries. You can see that as time has gone on, for both oil and gas, increasingly we've had to go, first of all, offshore. That was difficult. Then deeper water, and now, of course, ultra-deep water. And you look at where the discoveries are being made, and increasingly they're coming from those sorts of areas. And this all plays into a lot of the trends and things we've already heard about today in terms of the cost base, the increasing expensiveness of actually drilling for oil, and the cost of producing oil. One of the reasons for that is we're having to look further afield. And again, I think the context for somewhere like Denmark is that there's an opportunity to come back into play because there is this challenging environment. There is difficulty in finding a resource base. We've heard that the demand is going to be there for a very long period of time. So when you look at an industry that's increasingly having to look further and further afield for or more difficult oil and gas, I think you come back to areas that are perhaps more mature, perhaps more marginal, perhaps uneconomic, or were uneconomic in the past. And they start to maybe have a greater role to be played in terms of where they can go in the future. Now, this is a really interesting chart in terms of where things sit on the global scale. So what you're looking at is the overall maturity of the proven resource base. This is a 2P, proven and probable resource base of, well, a number of countries. And what you're looking at the blue is the not mature, the undeveloped, essentially, or at least newly developed oil and gas. And then you're looking at the light red is the stuff that's in production that is depleted, but not as depleted as the deep red, which is over 50% of reserves in place depleted. Now, I think the interesting thing here, I haven't got Denmark on this particular chart, but it's very much in keeping with Norway and the UK. It's obviously a slightly smaller scale than those reserves. But one thing you notice about the North Sea that I think stands out apart from the other regions is that you have two basic groups here. You don't have much of the sort of maturing production as you do in regions like the Middle East and North Africa. What you have is stuff that's not been developed in the blue, or stuff that's been really hardly gone after in the deep red. So what you have tended to have in the North Sea is production or fields which were considered uneconomic. We heard Trolls talking about a discovery from 1992 that has not been developed yet because it was deemed, and perhaps still deemed to some extent, uneconomic to advance it. Whereas the stuff that is economic, they go after very, very quickly and produce at a very high rate, partly because of the fact that the resource base was discovered at a later date, and we started to see more improved development techniques and the ability to actually produce that oil quicker and more efficiently. So I think what's important to understand about this and why this is something that's interesting to consider is that what's uneconomic very much depends on the wider context. And we're in a different oil price environment now. Technology advances. Yes, costs increase, but there's an overall balance that takes place that suddenly means that what we're seeing is more people going back, taking a look again at those fields they would have just passed over on their way to the next large discovery that could economically be exploited, and they're taking a second look at that. But you're seeing different people taking a look at that. So I'll talk about that in a minute. I think it's an important context for the North Sea in particular. And another thing to bear in mind in terms of the overall context and how you can develop and what is deemed economic and what is not deemed, what is deemed uneconomic, is that technology is constantly moving and constantly changing the overall cost structure in certain ways so that you can actually go back and redevelop things. Now, we can always talk, and I'm sure we will, there'll be a lot of discussion about what technology is coming through, where technology is improving, what needs to improve for the North Sea to really exploit the technology. And the way we'd like to think about it is there's really, I suppose, two different ways that you can improve your resource recovery. You can either go into increasingly difficult rocks, such as shale and chalk, which a lot of us have heard a lot about recently. I'll talk about in a bit more detail. Or you can get the more viscous oils to flow more easily. And there's a sort of wide range of different ways you can do that. There's also things like imaging and actually discovering it in the first place. But once you know where the resource is, these are really the key elements that come into play in terms of exploitation. And there's a huge scope for actually increasing those recovery factors. If you look at the world's resource base of oil and gas and how much is basically recovered, you're looking at less than 50% overall globally. So there's a huge chunk still there that is deemed unrecoverable, but there's scope always to try and improve those recovery techniques. And I think those are the sorts of things which are going to be much more important for a region such as the North Sea, where I think it's fair to say that the prospectivity is perhaps limited, or at least more limited than it has been in the past. But there's still huge scope for improving recovery rates through technological changes. Another thing to bear in mind when we're talking about what is economic and uneconomic is the price of oil. And again, I'll talk a little bit more about this later. But you just look here at such a wide range of cost bases for what is a break-even price for oil production in our view. So you have the ultra-cheap stuff in Middle East OPEC, and then other onshore and shallow water and conventional recovery rates elsewhere in the world, and then deep water and such on. And you look at something like US tight oil, and you see a massive range in terms of its recoverability. And you see something similar, I think. We're talking there about tight oil, and I'll talk about that in a bit more shortly. I think it's important for a region, again, like the North Sea, because it illustrates what happens when you get a sudden change in the external environment, which actually can, yeah, it's not a revolutionary change, but a small change in oil price is a bit of an incremental technological improvement, and suddenly you unlock a massive resource base. But you can see there that it's actually a very wide range. And you would see something similar if we just sort of isolated the North Sea here. You have some really inexpensive and very profitable shallow conventional fields which can be exploited. And then at the higher end, you've got really difficult reservoirs, viscous oils, heavy oils, and really difficult rocks to deal with and small amounts. But so the cost base can be very, very wide. You shouldn't really think of this as a sort of overall hurdle rate, but a sliding scale. Now, I just want to talk very briefly about the United States and shale. And I want to talk about this because I think it's important to show, again, as I just mentioned, what can happen when you get incremental increase in technology and a change in the external environment. But I should also warn that it's not necessarily always going to work out absolutely perfectly. Now, clearly there's been a huge increase in US crude oil production, and as we heard, and as we also think ourselves, that's going to continue up until about 2020, when we should start to see things leveling off. But it's been a real revolution for the United States, an area which was projected to have, I would say, 4 to 5 million barrels a day of production in around 2015. Just a few years ago, 5, 6, 7 years ago, you were looking at forecasts for a huge decrease in US oil production. And then you rapidly turn it around with this huge amount of growth, an extraordinary change. And really all that we've seen happening there is improved fracturing techniques. These are not new. They've been around for a long time. We saw the ability to actually get the resource base going by being able to license it off to commercial exploitation. And we also saw the willingness of industry to adapt new fracturing techniques and continue to drill and see if this was perhaps something that was doable in an environment where the industry started to accept that oil prices really were going to be above $60, $70, $80 on a long-term basis. And so two things conspire there that perhaps are not obvious in the short term to really unlock a resource base that was previously uneconomic. Small change in technology, slight change in the external environment, and then a government willing to with a regulatory regime which allows the industry to then exploit it, for good or ill, depending on everyone's views, really does lead to a significant and game-changing amount of additional oil being produced in the United States. So these are really sort of significant developments and an interesting, I think, an interesting way of looking at how the industry can emerge and change over time from unexpected or slow beginnings to something which is a little bit more dramatic. But, and this is where the warning comes in, it's actually not that economic at the moment. It's not uneconomic, it's not that profitable at the moment. If you look at where oil companies are going to get their returns, it's actually not from unconventionals. Now, there's been a couple of companies who went in very early, very skillfully, and very helpfully managed to exploit just the right sweet spots in the unconventional plays to get decent returns. The oil majors kind of missed out, came in a bit later, and what you're finding is a very, very competitive environment. And again, I think this is something that is worth bearing in mind if you're talking about Denmark and the North Sea, is that if you can actually generate an environment where you can attract that sort of inward investment, because there's so much limited opportunity elsewhere, you are going to drive a fairly efficient exploitation of that industry. Maybe not so good for the industry itself, although they're still obviously making returns on it, but certainly very good for the government and for the wider production of oil and the industry at large. Very challenging in the United States right now, but potentially still a very, very large source of production. So I think it's worth bearing in mind that once the opportunities are exploited and you have a government behind exploitation of this sort of resource base, you can really make a significant amount of competitive environment. Now, another thing I want to talk about in terms of the external environment you're dealing with is it's not all great for the industry as well. As perhaps it's unsurprising, It's a very competitive environment with limited opportunities. I think one thing that maybe might be a little bit surprising if you don't really take a close look at it is the fact that actually, despite the fact that we're now, okay, we're less than 100 for Brent at the moment, but we're still in a very high oil price environment. I can remember 10 years ago, everyone thought the global economy would fall over and die if the price got above 50. We're now, 100, 110, and still reasonably okay in terms of the global economic environment. But the returns aren't necessarily still the same for the oil companies. So what happened in the 1990s? Of course, we had what we thought was a huge amount of oil. We thought we had I can remember there was an Economist headline, and I think it was 1998, 99, saying oil was going to be permanently cheap. There was plenty of it. This was when oil was less than $10 a barrel. I can remember that far back, so it's hard to believe. But the industry was making roughly 5 to 15% returns. This is a very blunt measure of returns, return on capital employed year to year. But nonetheless, this is across the industry as a whole. 5 to 15%, and that was considered kind of average good for the industry. Then, of course, from 2000, we saw that steady rise in the price of oil up to 2009 in the global economic recession. And we saw returns go along with it, up to 15, 20, 25%. ExxonMobil was making very, very large returns, as well as the other majors and independents. Everyone seemed to be making a large amount of money off it. But now, since the price dipped but then bounced up subsequently to actually prices higher than at the peak in 2007, 2008, in terms of an annual basis, returns are back down to 10, 15%. And the reason for that is changes, again, to the external environment. Cost, one, but also governments elsewhere, not so much in North America, but in places like Africa and the Middle East, adjusting to the new price environment to take perhaps a slightly larger slice of the take. And so we're maybe coming back down to what is perhaps a normal level of returns for the industry. So it's challenging for the industry. Despite we have a high oil price, it's still challenging for the industry. And they're not seeing growth through production volume. That's certain. So you look at what's happened to the volume, this is just the last 3 or 4 years for some of the larger oil companies. They've struggled to maintain output. And in fact, that's no longer a strategy for a lot of these companies. It's not about volume, it's about profitability, it's about return, and it's about finding a niche. So the industry is having to focus a lot more in terms of things like cost controls, in terms of being able to focus on certain areas and perhaps specific types of plays, specific areas of the world. They're becoming much more focused on finding a competitive advantage than they are in terms of just going in and using the scale of their potential financial might and their ability to bring to bear large projects and push forward on those sorts of things, which they have in the past. So the industry is beginning to think slightly differently in this external environment. They have to. The industry has to adjust because the external environment, the resource base, is changing. And so when the resource base changes, you have to change with it. We've heard a little bit about this already, and I'm going to talk about a little bit about this in a bit more detail now. And cost is certainly one of the factors that's played into the returns being much less significant and substantial than they have been in the past. So from 2003 to 2008, roughly speaking, we had very high increases in terms of costs. These were things like drilling rig day rates, offshore rigs particularly, operational costs, the cost of metal, casings, everything was rising, labor, everything. And we've continued to see that subsequent, although our estimate is in the forecast that things are going to slow down a little bit. We are going to see continued increases in cost, but they're not going to be at the same sort of rate that we saw from 2000 to 2010. Nonetheless, they're significant, and as we already saw, they've already eaten into returns for a lot of the oil majors. And so that what's important to bear in mind here is that cost control is now a big factor for a lot of the industry and something that they have to focus on increasingly and make sure that they are very, very aware of, not just capital costs, but operational costs as well. And I think the important thing to sort of bear in mind there is that when you're dealing with more mature development, which is one thing we're seeing, You focus on things like tight oil, where we are seeing huge growth. That's very much like developing mature fields because it's quite cost intensive. Not so much a very large scale, massive drilling and offshore development project, but nonetheless you're having to go back into wells. You're having to constantly drill. There's a big operating cost there that's focused. And you hear a lot within the industry in the mature plays, North Sea, Southeast Asia, everywhere, that because the fields are getting smaller, or the discoveries, the fields that are being developed are smaller or more mature, a change in the cost base has a very significant impact on the potential for that field to become uneconomic in a hurry. Whereas in the past, you're dealing with very large projects, very large fields. You sunk the capital, and you're generally all right over the longer period of time because the production volumes and the risk-reward element were weighted quite significantly. When you're dealing in an industry where the finds are smaller, the fields are more mature, and the actual resource base is less likely to be larger and larger, what you're facing is more downside risk and less upside risk. And so companies are very, very focused on cost control, and they're very concerned about it because a small change in the cost base is going to have much more significance to them than even an increase in the oil price of $10, $15 on the upside, or extending the reserves in the field by 4 or 5%. They're not going to get the big finds. So cost, not only important for the overall industry in terms of just controlling it, but it's important for the way companies think about strategy and think about where they're going to invest. And we heard a little bit earlier about what's happening in deals. I haven't got the 2014 deal data here. The number of deals have fallen a little bit, and I think in terms of overall M&A, it's still strong compared to where it was in 2000, but I think we're seeing signs that it might be tailing off a little bit. I think that our view is that with oil prices where they are, we're seeing companies still. We saw Murphy just recently selling off its Asian assets. They're still in a market for buying mature assets, but they're valued quite highly. And in fact, what we have been seeing is the IOCs generally selling off assets and paring down their portfolio, and independents and niche players and national oil companies in particular making acquisitions. And national oil companies have done this, I think, and been the large source of buying because the price of the assets has actually been fairly high when you look at the actual dollar value of the proven reserves that people have paid for these assets. National oil companies maybe don't have quite the same financial restrictions as some of the IOCs and independent oil companies. And so they're perhaps a little bit more flexible in terms of how much they can afford to pay for these sorts of things. But I think it's worth bearing in mind that I think that this is something which increasingly, again, the industry is not necessarily going to be looking at deep pockets in an environment where they're seeing their returns dropping. And in fact, if you look at the capital expenditure projections for some of the majors, there is Statoil, sort of a national oil company, ConocoPhillips and BP, talking about increasing capital expenditure, BP perhaps for very significant specific reasons. The rest of the industry largely divesting assets or divesting some assets and focusing very much on very specific plays that they're focused on in terms of their resource base being very much looking at perhaps reducing their overall footprint and really just focusing on areas where they can drive returns. The point being here that the industry is not spending as freely as it was, and it's being very cautious in terms of where it is spending. And importantly for somewhere like the North Sea, if we look at it specifically here, it's a different type of company that's generally coming into play. It's national oil companies, be they domestic European national oil companies, or Chinese national oil companies. Asian national oil companies have interestingly become buyers in the North Sea, as the likes of Shell, Eni, BP, and so on increasingly sell off their positions as they look to focus elsewhere. Because for them, this isn't the sort of region where they can drive the sort of returns that they want to drive or feel that they can really compete. Some of the niche players maybe can focus a little bit more explicitly on a few small plays where perhaps they have a particular skill set and can really generate the returns and the focus that perhaps the oil majors don't. And again, this is something important, I think, for regulators and the wider industry to bear in mind, because you're dealing with different players to some extent, with different priorities, and perhaps who respond to different price signals. Obviously, everyone always responds to anything that's profitable and an investment that's good, but the risk structure needs to be adjusted, I think, to reflect that you're not going to have people going in and drilling wells primarily and getting huge discoveries anymore, where they're prepared to, sink a great deal of risk because there's a great deal of reward. We're talking about known resource base to a certain extent, and cost control, and understanding that the downsides for them are things like a slight increase in the cost of rig rates or whatever it might be, drilling metals, that can change the profitability of the project enormously. And so I think you need to think about the overall fiscal system in that sort of environment. So I'll just wrap up with a few thoughts and conclusions here. First of all, for the North Sea, large discoveries are increasingly rare. Obviously, the Barents Sea, not the North Sea, but still Europe accepted. There's still possibility of large finds there, different sort of industry entirely. Existing resource base has been pretty large. Their finds have been relatively easy. But what you're looking at now is that all those fields that were passed over when the pickings were rich, people are going back into those now and saying, in an environment where global resources are hard to find, and that there's a lot of above ground risk and a lot less opportunity for actually drilling and exploiting. They're looking at okay, well, what do we already know is out there that we thought previously was uneconomic? Maybe things have changed. Maybe the technology base has improved enough that we can get the flow rates up and the project becomes economic. So people are looking increasingly at mature fields, and so regions like Denmark and the North Sea in general have to some extent maybe a slightly longer lifespan than they do in an environment where you have much more competition in terms of large-scale finds possible. I think it's important also to think about the external environment opening up new opportunities, such as fracturing and horizontal well completion, the way that that's driven tight oil, and the impact that can actually have on mature fields in the North Sea, which it does. Heavy oils in the UK and in Norway and Denmark have become much more potentially competitive simply because of the advances we've had in understanding how you can produce tight oil in the United States. So that sort of thing always has a crossover effect. But again, I would focus on the things that it's a slightly different industry in terms of the way that the companies who are producing and exploiting the resource base are focused on their business model. They're having to adjust because the industry has changed. On a wider basis for upstream, well, this is a time of significant change. Cost is important, performance and returns increasingly important. And so how do you adjust to this in an environment where the resource base is smaller? I think what you're starting to see is that there are more focused in terms of IOCs and large independents are becoming more focused in terms of where they feel that they want to play. So at the moment, everyone's had a little bit of a dabble in things like tight oil and unconventionals, and perhaps even outside the United States. You will see more of that. But I think you're going to find that those players restrict themselves, and some are going to pull out completely. You're going to have ultra-deep water specialists. You're going to have companies who are maybe focused more on gas or LNG increasingly than oil. And I think you might have companies which see the advantage of going in and redeveloping mature fields. But I think what you're going to see is a much more niche sort of industry than we've seen in the past, where you had big and small players and essentially doing very much the same sorts of things, but geographically focused. I think now it's going to be more technically focused. And I think that there's still possibilities in terms of global tight oil, which maybe is something which is potentially to compete with the North Sea and mature fields. But nonetheless, I think there's reasons why that's going to be slow to develop. But again, I guess we come back to the same thing, and I'm sure we'll talk about it for the rest of the day. Managing costs and the cost environment is the key to the industry right now in the current environment. That's not to say it doesn't change. It changed in the last 5 to 10 years, and it might change again. But at the moment, that's the concern. It's not as a profitable industry, even with oil prices as high as they are, or at least not as profitable as it has been. And there are greater risks, I think, for companies who are sinking money into mature field development. So I think with just 15 seconds left on my countdown timer, I'll leave it there and say thank you very much for your attention. Thank you.